What if I told you that the biggest threat to American capitalism came from the very reforms designed to save it? That every attempt to fix the system, from the New Deal to the Deregulation Era to the post-2008 overhaul, carried within it the seeds of its next crisis? And what if I told you that the patterns driving economic instability today were all predicted decades ago, not by radicals, but by the architects of capitalism themselves? This is the story of how America tried again and again to reform capitalism, and how those reforms unintentionally reshaped the country in ways almost no one foresaw. Let's unravel how we got here and why the solutions keep backfiring. America has always viewed capitalism not as a system, but as a kind of national identity, a promise: work hard, innovate, and prosperity follows. But hidden behind that promise was a turbulent reality: boom and bust cycles, corporate monopolies, and extreme inequality. By the early 20th century, this invisible hand seemed less like a guiding force and more like a clenched fist. Enter the reformers, presidents, economists, and business leaders who believed capitalism could be improved, adjusted, even perfected. Their mission was not to destroy the system, but to rescue it from its own excesses. But every reform carried a twist, a consequence, a flaw. And that's where our story begins. The first great reform, the 1900s, 1930s, at the dawn of the 20th century. America was booming, but unevenly. The robber barons ruled: Rockefeller, Carnegie, Morgan. Wealth concentrated at the top, while millions worked in brutal conditions. The public reached a breaking point: the Progressive Era, antitrust laws, the Federal Reserve, new labor protections. The goal was simple: rein in the giants, stabilize the system, stop the most violent boom-bust swings. For a moment, it seemed to work, until 1929. The Great Depression didn't just crack the system, it obliterated public trust in it. Banks collapsed, unemployment soared. The American dream felt like a myth. The New Deal, Franklin D. Roosevelt's sweeping overhaul: the SEC, FDIC, Social Security, labor rights, public works programs. For the first time, the federal government became the stabilizer of last resort. And it worked. It didn't end the Depression on its own, but it built a safety net, regulated speculation, and created guardrails that would define capitalism for nearly half a century. But hidden in the success of the New Deal was the foundation for the next crisis: post-war prosperity. 1945 to 1970s, World War II ended, and America entered its most prosperous era. Inflation was low, wages grew, corporate profits soared, the middle class expanded. Economists called it the golden age of capitalism. But beneath the surface, pressure was building. New Deal regulations made finance safer but also rigid. Corporations wanted more flexibility. Investors wanted higher returns. And politicians, eager to maintain growth, began loosening the rules. A new philosophy emerged: the market knows best. By the late 1970s, economic stagnation, oil crises, and high inflation convinced many that government had become the problem, not the solution. This was the turning point, a pivot that would reshape capitalism more dramatically than any reform before it. Deregulation 1980s 2000s enter the deregulation era. Reagan, Thatcher, Friedman, and a chorus of economists promoting free markets above all else. Deregulation. Banks gained new freedoms. Corporate mergers were allowed. Wall Street innovation exploded. Globalization accelerated. Computerized trading and financial engineering promised efficiency and endless growth. The idea was simple. Remove the constraints, and the economy will soar. And it did. But something else soared too. Inequality and risk. Wall Street's new inventions, junk bonds, derivatives, complex securities created profits faster than policymakers could understand them. The guardrails of the New Deal designed for 1930s capitalism no longer applied. Twice, America got warning shots. Savings and loan crisis in the 1980s, dot-com crash in 2000, but each time, instead of reversing course, the solution was to open the floodgates even wider. By the early 2000s, the economy was growing on financial engineering, cheap credit, and speculation, and that's when the system snapped. The 2008 financial crisis 2008 wasn't just a crash, it was the result of decades of reforms, layered on top of each other, amplifying vulnerabilities each time. Mortgages bundled into securities, ratings agencies labeling risky assets as safe, banks borrowing more money than ever, a belief that markets would self-correct. They didn't. When the housing bubble burst, it wasn't just a failure of banks, it was a failure of the entire reform philosophy that had guided capitalism since the 1980s. Millions lost their homes. Trillions vanished from the global economy. For the first time since the Great Depression, Americans questioned whether capitalism itself was broken. The post-crisis era 2009 present. After 2008, America tried again to reform capitalism. Dodd-Frank and the new regulatory wave. Tighter rules on banks, stress tests, consumer protection, more oversight of derivatives. But the fix was incomplete. Banks got bigger. Problems moved to the shadow banking system. Corporate consolidation continued. Tech giants gained unprecedented power. And the biggest flaw, the reforms stabilized the system, but didn't address the underlying cause of instability, dependence on ever-increasing credit and financial speculation. When the pandemic arrived in 2020, trillions of dollars were injected into the system. It prevented collapse but also triggered inflation, asset bubbles, and new dependencies on intervention. Capitalism wasn't functioning independently anymore. It was on life support. The patterns return today. The symptoms look familiar. The top 1% controls more wealth than the entire middle class. Corporate profits are at record highs while wages stagnate. The stock market decouples from the real economy. Debt consumer, corporate, and government is at historic levels. These aren't random events, they're repetitions. The same cycle keeps returning. The system becomes unstable. A reform stabilizes it temporarily. That reform creates new incentives. Those incentives create the next crisis. It happened after the Progressive Era, after the New Deal, after deregulation, after the 2008 crash. And now, the pattern is visible again. America didn't fail to reform capitalism. It failed to understand that every reform reshapes capitalism. and those changes carry unintended consequences. Closing section takeaways. Warning. Call to action. So, what does all of this mean? Here are the 3 takeaways from America's century-long experiment to reform capitalism. Capitalism adapts sometimes too well. Every reform designed to stabilize the market also creates new incentives. Those incentives reshape the system in unpredictable ways. Stability breeds risk. When crises are prevented for too long, people assume the system is safe. They take bigger risks, use more leverage, and build instability under the surface. You can't fix capitalism without understanding how past fixes broke it. Most reforms treat the symptoms, not the underlying mechanics driving inequality, speculation, and boom-bust cycles. Now for the warning. America is once again debating how to reform capitalism, whether through regulation, innovation, or redistribution. But unless we confront the hidden consequences of past reforms, we might repeat the same mistakes. The next turning point is already forming. The question is, will we recognize it in time?